New York Fed President John Williams says the economy can eke out gains in GDP and avoid a recession this year. Joining us now, Joe Livornia, former economic advisor in the Trump administration and National Economic Council chief economist. He's now SMBC Nikko Securities of America chief economist. And Dana Peterson, chief economist with the Conference Board. Joe, I think you don't believe it. Dana, I don't know whether you would buy into that. The economy has been pretty darn resilient, and the labor market pretty resilient. Maybe not 2023. Is one coming obviously at some point, but is one coming in the next year, do you think, Dana?
Yes, we do expect that there will be a recession. It's probably starting right about now. All of our indicators suggest that. Leading indicators, consumer confidence, CEO confidence, all point to a recession in the U.S. economy. We have seen slowing in activity. Certainly, consumers are spending less on goods. They're saying they're going to spend less on services, and businesses are already pulling back.
If someone on the Fed was watching, Dana, after hearing that, don't you think they should pause? Mission accomplished?
Well, the thing is that we haven't seen services really come off in terms of consumer spending, and that's really what's driving inflation right now. It's housing, it's also spending on travel, hotels and restaurants, as well as food inflation, especially for groceries. And when we look at the core inflation measures, they're still very sticky. And so I think the Fed really hasn't completed its task just yet.
It's interesting. So they could have already gotten what they wanted in terms of a recession, but there's pockets that are still stubborn and sticky, as you say, so you think they should stay the course. That's interesting. What do you think, Livornia?
In 2008, Joe, we as economists were debating whether the economy was in recession. Many thought in the spring after Bear Stearns was basically bought by JP that we had avoided the downturn, the economy would be okay, the soft landing was there. Risk assets rallied quite substantially. It turned out after the fact that GDP, which had been positive, was revised down, and the recession started in January. So the data aren't very good. And so Dana's point that right now we could very well be in recession could be true, even though it doesn't necessarily feel like that. The Fed is making a classic mistake of forgetting that there are lags. Inflation is sticky, but headline has come down, Joe, a lot. We were at 9, we're now only at 5. It's going lower. Food and energy prices in particular are likely to moderate. If the Fed's waiting for inflation to come down to closer to 2%, they're really going to overdo it because we know inflation moves with the lag because it's sticky in some components. So this is classic Fed mistake. They all think the same. It's groupthink. And when they have a recession, they're going to try to dodge the fact that they're the ones that caused it.
So you'd say, I can see if I were the Fed, Joe, another 25 basis points is not going to change the recession outlook that much, I would think. And it might psychologically bolster the Fed's inflation fight, which can also be self-fulfilling. So I can see how they'd argue that it still makes sense.
Yeah, but
you don't think,
but
you don't think that,
no, I don't
you don't even think the
sense,
last
no.
25 made sense, do you?
No, it's like you don't need the extra 25. I mean, it's the proverbial maybe straw that breaks the camel's back. They already have inflation fighting credibility. The break-even inflation was at 3% when they started hiking back in March of 22. It's now down at about 220, 230. Every inflation expectation metric has showed us for the last 12, 13 months, the Fed has inflation fighting credibility. The problem is that what the Fed doesn't have credibility with the markets is that the markets think the Fed's still going to ease and the Fed's pushing back against it. I would have stopped a long time ago. That extra 25 basis points is going to do nothing to stop what will continue to be deposit flight out of commercial banks, because that higher 25 basis points, that's going to be reflected in bill rates and money market rates. So the Fed's working now at a cross purpose to financial stability while the economy is certainly weakening.